Hey traders, welcome back. So I want to talk about another trading strategy. This one from Linda Bradford Rashke again. Check out the previous videos if you want to see some strategies talked through, looked at, examined a little bit more closely, run through and see if they're still valid today in the current market conditions. So this one's called Whiplash. Now the idea of this is that you're taking advantage of gaps that kind of don't continue. That's the theory of it really. You're looking for a gap, that doesn't follow through, that actually shows a bit of opposite strength. I guess that's the point of the whiplash. And then this one's specifically holding overnight. So there's some risk in this one, but let's talk through it a little bit deeper. So this is for buys. These are the rules for the buys. For sells, they're obviously reversed. So today the gap has got to be below yesterday's low. So one of those gaps that, you know, literally gaps out of the range. So if it gaps below the low, you're looking at it. If it gaps above the high, you're looking at it for sells. That's your first criteria. Second criteria is the close of the day. So after you've got that gap, the close has got to be above your open and in the top 50% of the range. Now that rule makes a lot of sense because that's basically saying there's continued strength. If you're talking about a gap lower, it's pushed up higher, the open is low, it's pushed up higher, it's closing near highs or it's closing the top range, hasn't kind of done a flurry and then reversed. It showed a bit of strength, buyers are still willing, and you know it's kind of a premise or a precursor, should I say, for it potentially to follow through and move higher the next day. That's the idea. So if you get one and you get two, you buy at the close. So literally you buy at the close and then you wait for the next day. So obviously this is a little bit where you've got a bit of risk involved in this trade. You're giving up a lot of the control of risk by holding overnight. However, you know, this may well be suitable if you've got the correct sizing of your position. It shouldn't matter too much, but just be aware of this. So on the next day, if it gaps against you, in other words, it gaps lower if you're long, dump it straight away. The rule is you get out straight away, even though it's sometimes tempting to stay in it. The rules say get out, clear it off the deck. If it gaps higher on you, you trail it. You try and trail it. And again, a lot of these with Linda Bradford Rashke's strategies, she kind of open-ends the exit strategy a little bit more. So that's kind of something that we could build on. And if you've got any ideas on it, stick it in the comments below on how perhaps you would manage a trailing exit, or whether there's a specific target you'd aim for as a limit to exit a winning trade. But again, you can add your flavour on it if it's something you want to trail with a moving average perhaps, or you want to look at a certain number of days. That's something that perhaps be back tested. There are loads of opportunities, but let's look at the core of the strategy. Okay, so I've used an ETF here called SPY, which is the S&P 500 ETF. You may be familiar with it. I've used it before in other videos. The reason I've used this is because if we're using gaps, we don't want to use a 24-hour session product like the Dow, which trades overnight. Futures trading, S&P 500. We want to use something that's cash based. An ETF is a perfect thing for it because it's broad enough that there's a lot of influence on it. I guess stocks would be great for it as well, but there's a distinct closing price on it, which is what you need. So some sort of commodity would work very well for that's got distinct closing price, stocks and an ETF. So let's have a look in the spiders and see if we can see something on here. So let's remind ourselves of the criteria. We're going to have a gap lower, and we have to the close has got to be higher than the open and in the top 50% of the day's range. All right, I can see one here. This is a gap lower, right? But it closes lower, so no deal. This is a gap, doesn't count. This is not a gap lower. This is a gap higher, but it closes higher, so these aren't counting. None of these are counting. That's not counting. That's not counting. The first one I think counts is this one. Guys, let me see if that arrow works. I can just about see it, but it's this candle here. Criteria 1, we gap lower than the prior day's low. Prior day's low here is 203.87. The open for this candle is 200.49. Correct. Now, do we close above the open? Yes, we do. It's a green candle, and we close pretty much at the high of the day. Well, the high of the day is 03, the close is 02. It's definitely in the top 50%. So your trade is to go long at the close. You've got to just commit to this one and obviously be careful that you're not in too much size, and look at the gaps that you can have if you're caught out on it, so be aware of that. yeah, you're looking to go long here. I guess actually, just to digress slightly, you could probably do this and then hedge yourself off on a spread bet on the 24-hour. If maybe you got a really good move overnight and it hit your target and you'd already planned out what you're going to do, hedge yourself off. Then you're completely neutral, then the next day you square it off, or perhaps you could use it as a stop. Something to think about anyway. Okay, so you're gapping up. It gaps up the next day. The close was 02, right? The open was 40. Nice, that's a nice little profit. I guess you either, depending on how you're trailing this, you're either going to have a profit on this, or you're going to have a small loss, aren't you? Because it hasn't continued several days. If you're looking for the continuation for several days, you're probably going to be stopped out on this one. If you're kind of taking some off on the initial impulse, you're probably okay. Alright, let's look at some more, guys. This one here seems to work very nicely. We gap down out of the... Did we... actually interesting. Let's have a look. The low is 187.66. The open is 186.77. So we have just gapped lower by quite a fair bit. And let's see, we closed. Are we in the upper range? That was the key. I think we are in the upper 50%. So that is actually a long on the open. Let's look at the criteria again. Remind ourselves, gap below the prior day's low. Check. Market is closed higher than the open. Check. We've got a green candle. And it's in the upper 50% of the range. Check. So we go long at the close. So our entry price would be 187.81 in this instant. And the next day, we've got a nice gap up, guys. We've got a nice gap up on this one. The open is 189.96. Decent trade. I guess if you're trailing that, you're obviously going to be stopped out on that with some form of stop on a trailer, but that looks like it's a profitable trade. The next one looks even nicer to me. That's a gap below the prior day's low. Open, it closes higher, above 50%. Gaps up, you might have a chance of a good move. Anyway, we could go on and on here. We could use all sorts of different ETFs like USO, or some of the other ones out there, maybe the VIX ETFs, whatever it may be. I like it. The weakness obviously is that you're giving up the risk overnight, but there's potentially a hedge there using a spread bet if you were so inclined. And also, I guess in reality, what you probably do, as we're all spread betting here, most of us are spread betting here, you take it on a spread bet anyway. You'd look at your spiders or your diamonds. Obviously, your spiders, the S&P 500. Your diamonds is your Dow Jones. And then you'd see if it triggered on that. You'd take it on a spread bet, but then you'd still treat it exactly as a rule. So you take it on the close, even though it'd be trading overnight, you'd then exit at the open, or if it looked like it was going to open lower anyway, you could exit. So you kind of manage the risk with that anyway, without having to go actually directly and trade the ETF. So it's something to think about. I like the strategy. There's some vulnerabilities there. Of course, I think you've got to refine that exit a little bit more, work out what's the best way to hold it, how to trail it. So if you've got any ideas on the exit, would love to hear your thoughts on that in the comments below. Whether you've got a fixed exit, fixed percentage perhaps of the day's move, maybe of the ATR, something like that, or maybe a trailer on moving average. All those I think have probably got good ideas. Or even if someone back tested and said 3 days ahead, 4 days ahead, 1 day, all that kind of stuff, that would make sense. And guys, if you like this video, I'm going to do more of these. We'll examine strategies, setups, dig into them a little bit and see if they work. And the good thing about these is if you can use them as a foundation, tweak and adjust for your own strategy playbook, it's great. If you look at it, it's not for you, discard it. It's not for everybody. Each of these setups, you kind of look at them and go, yeah, I like them. Or you look at them and go, nah, I don't really like that. That's the good thing about trading. Anyway, guys, give me a thumbs up if you like this video. Don't forget to subscribe if you haven't already for more videos from me and other traders on this channel. And I look forward to seeing you in the next one. Take care. Bye-bye.